All right, is the market missing the big picture on rising commodity prices and the threat it could pose for the economy? In other words, could Main Street be sniffing out growing inflation that is totally lost on the Fed and other ivory tower economists? Powerful PIMCO CEO Mohamed El-Erian seems to think so. Take a listen to what he had to say this morning on CNBC.
When the economists look at this, when market participants look at this, they call it transitory. When Main Street looks at this, it says this is not transitory, guys. This is hurting me. It's true for inflation. It's true for unemployment. If you go globally, it's true for what's happening in Greece. So I think that we have to stop using this word transitory.
All right, so is Mr. El-Erian right? I think he's right on target. Let's talk about it. We have CNBC contributor John Rutledge, former Reagan economic advisor and honorary professor, Chinese Academy of Sciences. And we welcome back Peter Cohan, president of Peter Cohan and Associates, co-author of Capital Rising. Hello, gentlemen. John Rutledge, start with you. Too much money chasing too few goods and assets. The dollar sinking. What is your take? Is there a serious inflation threat or not?
Larry, Ben Bernanke is transitory. He's sitting in the punch bowl right now. He is not going to leave it. Look, there's fire. This inflation story is like firewood stacked around Joan of Arc's feet. It hasn't caught on fire yet. It's been wet. That's the unemployment story. But it's drying out and there's smoke. The big story for inflation is the small cap stocks have lit up because banks have started lending there. That's what's going to drive employment up, unemployment down, and inflation will be let out of the barn again. This inflation story is a big story for the currencies, for the commodities, and for the economy.
All right, Peter Cohan, the market signals commodities, gold, the dollar, until very, very recently, is signaling inflation. John Rutledge is saying all those new reserves the Fed created will be unleashed into inflation. Do you agree?
No. John is very, very clever, but also wrong. And I'll tell you why. There are two components of inflation. The Fed cares about labor rates. Labor rates are going down. The unit labor costs are down 1.5%. Productivity was up 3.9% in 2010. And over the last decade, the average family income has been down 8.1%. So there's no threat of long-term inflation as far as the Fed is concerned because those labor rates are going down, 9% on unemployment, and the threat of outsourcing or part-time jobs. There's no way people are going to get raises.
Wage push inflation went out in the 1960s. Look, that's what the Fed thinks. That's not where inflation comes from. Inflation comes from increasing the stock of money relative to the stock of goods.
And there's excess capacity in the economy.
Hang on. Go ahead, John.
Okay. Reserves are up 1,700% since the financial crisis started. There are now $6 of bank reserves in the U.S. for every dollar of bank reserves in the European Union. That was 1-to-1 2.5 years ago. That's why we've got a weak dollar. That's why we've got rising metal prices and commodity prices.
All right, so Peter, you have this release of reserves, this creation of reserves. You've had a very weak dollar, maybe until very recently, and you've had the signal from commodity indexes and gold. So apart from the labor argument, Peter, what's wrong with John Rutledge's argument?
Well, there's the commodity argument, which is that the Fed has created money by having 0% interest rates, which commodities traders who control 81% of the commodities trading have invested in going long commodity prices and going short the dollar, which, of course, creates a nice snowballing effect. And what happened is that the CME group decided to raise the margin requirements for those traders. And, for instance, the margin requirements for silver were up 230% in the last month, and the margin requirements for oil were up 25% in the last month. And what does that do? The price goes right down from 114 to 100. The price of all these commodities like silver plunge. I mean, it's a very simple, my book is Capital Rising. And what's happening is that the amount of capital that traders have to set aside for those commodity trades is going up dramatically because the CME wants to pop this bubble. And when they do that, they will exit the trade.
That's basically, though, John Rutledge, that's really a silver issue. I mean, oil has come down, grant you that, but relative to a year ago, 2 years ago. In other words, John, I'm asking you, are the inflation-sensitive market indicators going to be wrong this time?
I don't think they are, Larry. You know, the margin requirement is up. It did bite in. It did hit the prices. But the real driver here is people's view of the long-term price level and the growth of Asia. And look, a real question is, will the Fed have the courage to suck $2 trillion of bank reserves back out of this system? If they don't, and they leave it where it is today, the U.S. price level is going to triple based on everything we've seen in history. The group we have now of inflation doves at the Fed, Barney Frank trying to hamstring the Open Market Committee last week, financial reform changing the way the appointments are made at the Fed. The Fed is no longer the Volcker Fed that people feared. This is the dovish Fed of Ben Bernanke.
All right, we're going to leave it there. Thank you, John Rutledge and Peter Cohen, who disagrees. Appreciate the debate.